Okay, hello everybody. Welcome to our retirement planning seminar. Hopefully we'll have a little bit of fun tonight. Retirement planning is one of the things that we get the most enjoyment out of, so I know I'm looking forward to this. Um, so I'm Mark Swingle. For those of you that don't know me, I'm a certified financial planner. By looking at me, I've been doing this a long time. I'm the senior partner here. Also presenting with me today is Tim Wynn. He is also a certified financial planner, and some of you may not know this because it just happened recently. Tim is also a partner and advisor with us here. So he's going to do the second half, if you will, of the presentation. Dan Song, another recent partner addition, is also part of our team here. He's going to be in the background tonight, answering if you put any questions into the chat box. He's going to address those as we go along, or possibly encouraging you to wait until, because at the end of my presentation, we're going to open up everybody's microphone and give you a chance to, directly ask some questions then, so you can take some notes along the way. Or he'll answer you in the chat box as we go along. So, and just to complete our team, we also have Denise Colleran. She's our client service and compliance director. Mary Kay McCourt, our office manager, and Mary Harris, our marketing manager. Mary Harris has been the backbone of putting this together in many of our marketing efforts. So thank you, Mary. And just, I mentioned, if you want to ask a question, there's a chat bottom at the bottom of the screen. Dan's monitoring that. Otherwise, at the end of this presentation, we'll give you a few minutes to unmute your microphone and speak. What we do, so we are Westfield Financial Planning. So financial planning is the focus of what we do. And a lot of people think about us in terms of investments, and that's certainly a key component of what we do. But it's all built around planning and financial planning. And today, of course, we're primarily talking about retirement planning, as this red highlighted note here says. So now this presentation is going to be two parts. The first part is me going through a deck, talking about some of the issues that come up in retirement planning. So my job here is to kind of point out some problems that we can run into, or you can run into as you retire. And then when Tim comes up, he's going to come up with a demonstration of our retirement planning software, which is basically, he's going to provide a solution to what may disturb you as I talk to you. So, okay, so onward. Here's the presentation. Thank you, JP Morgan Asset Management, for helping us with this. They put the bulk of this part of the presentation together. And here it is, what they're calling the retirement equation. And this is broken up to things that you control, things that you have no control, and things that you have some control. So the things that you have some control of, we cannot help you with. That is your employment, obviously earnings, and how long you work, and how long you live. And those, they're saying you have some control over. And then the things that you have total control over is your saving and your spending, and your asset allocation and asset location. So saving and spending, pretty obvious. Asset allocation, we'll talk a little bit about that. Asset location is where an asset is held. If it's in a tax deferred account like 401k, tax-free account like a Roth IRA, or in your taxable account at the bank or with us. Those are different places you can hold them. So all those places have different implications and help you retire. And then there's the piece that things are out of your control. Let's start with the easy stuff. The government can change tax policy. Your company can change benefits. All that stuff you really have no control over. And then there's the market. And of course, we know, particularly in the past several years, how wild the world can be right now with Ukraine going on. So the market we have no control of. We help you with all these things, other than your longevity and your employment, but we help you with all these things. So with the market, we try to get you in a place that you can handle whatever volatility comes your way. Can't get rid of it, but we can damp it down so you're a little more comfortable and you can stick with your plan. Because at the end of the day, sound retirement plan requires you to stick with it. Okay. So the first thing is life expectancy. How long do you expect to live and how much? And sometimes people come with unreasonable expectations. So there's a lot of data on this page. Let me just focus on the 95-year-old data, which is the third one from the left. And the tallest chart there, which is the light blue and dark blue together, says 44%. So that is the probability that a couple, husband and wife, or it could be, any kind of two people together, age 65. What is the probability of that, at least one of them lasting till age 95? So that's 30 more years. So the probability is 44% for essentially our clients, which are, our clients are non-smokers in excellent health. So that's a 30-year probability, age 65, and that's the time frame that we need to at least apply for. Although I will say, we had I don't recall, it was a client or prospect that was in a week or two ago whose grandmother lived to 111, I think it was. So, there's some long time frames that we have to plan for. Okay, next slide. So Americans, we are working a little longer into somewhat of an older age. And the top of the chart shows that in 2020, 27% of the workforce was between 65 and 74, which is pretty high, higher than I would have thought. So a lot of us are working past the age of 65. That's my plan. So that's kind of amazing. And then there are, why would they be working in retirement? Well, and that's what's in the bottom half of this chart. Main reason why people want to work that long is, and I just gave you the answers, because they want to stay active, involved, and they enjoy working. So that's 52% and 38%. And then there's some financial reasons up above. You see that, buy some extras, make ends meet, and that's obviously true. But the primary reason is, good reasons. They want to stay involved. Okay. However, prior to retirement, you got to think about, when will I retire? And if you had asked me, maybe in my early 40s, I would have said, 60, 62, and I think I'm gonna blow past that. And many people think the same way, and that's essentially the typical answer is I'm going to retire at 65, though. But what happens is they do actually retire at 62. So I kind of threw you off the track a little bit there. But at the end of the day, people, and that's what you see on the bottom left side, it's expected that most people are going to retire at 65. More of them actually retire at 62. So why is that? Why are they retiring sooner? Two reasons are the main reasons, are health problems or disability. So in other words, or company downsizes and closing. You put those together, that's kind of the bulk of it. But also down below, you'll see 41% able to retire early. In other words, they can, so they decide to. So it's kind of a mixed bag. The important thing, I guess, is to start sooner rather than later. Aggressively work on this so that if you have any kind of a health issue, and that doesn't mean you can't get around and can't enjoy life, it just may mean you don't have the energy to work the same capacity or stress level you did in the past or don't want to. So you want to basically get yourself in a position to be able to do that sooner rather than later. Okay. Pensions. I wish we all had pensions. Pensions are disappearing. You see, this biggest thing is the silent generation. They call it age 77 plus. 51% of them have a pension. So many of my older clients have pensions, are our older clients. Baby boomers, fewer and fewer of us have pensions, only 39%. And as you can see, that's getting lower and lower and lower. So that means it's up to us to manage our own pension, if you will, our own retirement income. So there's work involved in that, and it can get complicated. So we obviously that's why you're listening tonight. Okay. Social Security. When do you take Social Security? Do you take it 62? Do you take it 65, 67, 70? So there's a lot that goes into that decision for people. It's a very complicated chart. There were 3 other slides that I got rid of because it's just too much. And we're not going to go through this. At the end of the day, what we do here is we have this retirement planning program we use that Tim is going to go through that will essentially, we'll put in all the data for you. We're going to get all the answers for you ahead of time, and we're going to be able to demonstrate for your particular situation when is the best time to take Social Security. And it's going to answer all these questions in a very graphical, easy to understand format, so you won't have to fret about it so much. Okay. If one of you has any specific questions about Social Security, if you were thinking I was going to answer that, we can certainly, and we do on a regular basis, try to help you through a specific question. You can chat in with Dan in the chat box or ask me afterwards. Okay. Leading up to retirement, it's not unusual for there to be a couple of years before you hit Medicare age. You retire at 62. That means the next several years you got to buy insurance privately. Obviously, that's going to be expensive, and if we're going to be planning for you, we're going to include those costs in your plan. So this is essentially showing some of those costs. The far right is at age 64. On the national average, just over $1,000 for insurance for a single person, age 64, and then the out-of-pocket costs are $300 roughly. These are monthly numbers. So that's something that we have to take into account. And then once you get retired, there's also a cost to Medicare. And this is showing at age 65, $508 Medicare cost of retirement. And that, of course, they're showing that going up through retirement. And all your expenses with inflation, right? This year, inflation was very high. Previously, it was pretty reasonable at 2%, but we include that rising costs in your plan. So we have to plan for that. Something that kind of surprises people, that's this page, Medicare surcharges. So, the idea in retirement that taxes are going to be a lot lower for a lot of people is not really the case. And the reason why it's not the case often is because they're taking money out of the retirement plans. When you put money in your 401k, your IRA, your SEP IRA, profit sharing plans, when you're working, it's a tax deduction. So you didn't pay any tax on that money going in there, but when you take it out to live on retirement, you have to pay income tax on that. And if you've done a good job of saving money over many years, you can have a lot of money there. So it can be a surprise that, depending on your modified adjusted gross income, that in addition to those other Medicare costs I showed earlier, you could pay a surcharge as your income goes up. And we can help you plan for that. So, basically at about $200,000, the surcharge starts. That's $200,000 modified gross income. That's $80 a month. And then at about, say, we'll call it, because I'm going to go right in between here, $250,000. It's $200 a month. So these surcharges, and there's really not much you can do about it. You need that retirement income to live on. So it's just something that has to be taken into account. Okay. A Roth IRA. So Roth IRA versus a traditional IRA, 401k. We've been hearing about this for years. You put money in, it's not tax deductible when you put money in, but the growth in it is tax free. And when you take money out, you don't pay any tax on the gains. It can help you to manage your taxes at a later age so that some of the income you don't get taxed at, which will reduce your modified gross income. So maybe you won't pay that Medicare surcharge we were just talking about. So it's good to have some, although it's not always good for everybody. So if you're in a very high tax bracket, it doesn't make sense to do a Roth IRA. You're better off doing regular contribution that's tax deductible. Hopefully, even though you'll be paying taxes in retirement, you'll be paying tax at a lower rate, in which case you definitely want to be using traditional 401k approach rather than a Roth IRA. But that's something that we look at on a regular basis for people, because we can, if you are unemployed for a year, or if you sell a house at a loss, or if you have between 65 and 70, you're not working and you're not getting much income, maybe we can do a Roth IRA conversion during that time period, such that we're not paying a lot of tax on the conversion, and then you'll have a Roth IRA. So that's certainly something that we would bring up as we work with you over time. And this chart is just talking about those various sources of retirement savings, places to get your income from. Diversifying those buckets is a good thing. This is showing a Roth, a taxable account, and a 401k IRA. It also has a health savings account on here. That's also a good thing if you can, if you have enough cash flow to do something like that. And all these can help you manage your taxes and your retirement income a little better when you get there. Okay. So retirement spending. So this is breaking retirement spending into 3 phases. The first phase is showing, if you look on the bottom, is from age 65 to 75, basically saying this is your healthiest time. Maybe you'll be doing the most spending, you'll be traveling the most, you'll still be eating steak and lobster, I guess. Then you get into the passive slow go phase. Maybe you're more concerned about your cholesterol, you're gonna go out to eat less. Maybe you're gonna just travel to Florida instead of to Europe. So I don't know. So with our clients, that doesn't happen so much. Sometimes it does. It's not something that we plan on. So if it happens to you, maybe that'll just give you some more flexibility in your spending. We hope that our clients stay, very vibrant and out there in the world as long as possible. But it is something that we can touch on. I see Mary looking at her watch. Hopefully I'm not taking too long. Okay. Here's something called the 4% rule. Essentially, this is, if you have in the left-hand chart shows you have $1 million to live on at age 65. How long is it going to last? And this is based on a 40% stock, 60% bond portfolio. So that's a pretty conservative portfolio. It's a more conservative portfolio than most of our clients at that age. So with that kind of a mix and just a mechanical taking money out each year with inflation, the 4% rule, it's going to last past 30 years, so beyond age 95. And if you take 5%, it's only going to last 25, et cetera. So the 4% rule is a rule of thumb that's out there. It has a lot of validity. There are other things we can do, and we do to help increase that a little bit, but it is something we kind of ideally look to get close to in the first years of retirement. So that's something we'll pay attention to. Now, this is one of the reasons why that's important. So typical retirement projection is a straight line projection done with averages. And of course, as we know, the markets do not give you the same return every year. What the markets do is you'll have a year where it's down 20 and the next year it's up 20. So if you have kind of essentially bad luck with the first several years are bad years and then you have good years, you can have a very good return over time, but still run out of money just by timing being bad. So that's showing this. The top is showing a portfolio value, 1996 to 2000, with the withdrawal just manually, just automatically straight line increasing every year with inflation and running out at age 90, versus the one with the above that, which where the performance, they essentially take less money out in the year the performance is bad. So that essentially absolves the problem. There's other things that we do. For instance, we only take out of the bond side. That can do some of the same stuff. It can keep your income higher so that you don't run out of money in that way. Okay. All right. The benefits of saving and investing early. we've been hearing this all our life, starting with Benjamin Franklin, penny saved is a penny earned. I'm watching him on PBS right now, his biography with Ken Burns. So if we look at Nervous Noah, that's the very bottom green line. He saves 25 to 65, but he's nervous and he just puts it into very low earning cash. That grows to 147,000 by the time he's 65. Now, of course, we would never recommend that. We would always recommend being diversified, having stocks, bonds. You can have a little bit of cash in there. So let's look at consistent Chloe. She's invested from 25 to 65, but she's earning 6.25%, which is going to be similar to that much more diversified portfolio. And you can see that she's got almost 4 times as much as Nervous Noah. She also, if you'll note, compared to late Lila, where she starts 10 years later, that's the purple line. She basically has half as much as Chloe, even though she invested the same way. So, obviously we want everybody to be consistent Chloe. And we've had a number of clients, sons and daughters come in here recently, and we're making sure that they get started on this right away, right out of college, essentially their first job, so they're right on their way. So here's more of the different strategies. So this is about putting in the 401k. And if we look at on the bottom, the blue line, Stubborn Sarah, she starts at the minimal contribution 3%. So she's age 25 to 65. Hers is growing to 600,000. The top one, Super Sam, he starts at 10% and stays there. He's got the most. But Escalating Ethan starts at 3%, gradually increases every year until he gets to 10%. He gets to almost the same amount of money. That's more typical of what we see, and that's a very successful strategy. So that's good. Okay, so this is really my last slide. You probably heard enough of me at this point. And what we're talking about here, obviously Ukraine, COVID, contested election. The last several years have been just the anxiety is just coming out of people's pores, I think, with all that stuff. And it's just so important to stay invested and stay with your plan. And we stress that again and again, and we try to hold your hand as we get somebody started, as we get them on track. And this is basically saying, so somebody invested $10,000 January 1st, 2002, the S&P 500, which is the 500 largest U.S. companies. And by the end of December 31st, 2021, which is basically 20 years, that $10,000 has grown to almost $62,000. Now, if they missed if they miss 7 of the best 10 days, oh, no, what am I saying here? If they missed 10 of the, I guess, 7 of the 10 best days, they would end up with 28,260, roughly 1/3 as much. And the issue is usually that somebody gets out of the market, say in March of 2020, right at the worst time, and then they miss the best days on the upside. You just need to do that once or twice, and that's the number you're looking at. So that's what we very much need to avoid. So with that, I'm going to open it up. I guess Mary will open it up. Yep, and so everybody who wants to ask a question verbally, they can just introduce yourself and say something, and we'll try to answer your question if we can. And if you, we're going to open it up again at the end after Tim does his piece, which won't go as long as mine, thankfully. And you can ask questions then as well. So at this point, it looks like, so Dan, I guess there's no questions on your chat box, right?
No, I don't see any here.
Okay, good. Okay, so then in that case, I'm going to stop sharing, or Tim's already done that. And Tim, as I mentioned, is a partner here, an advisor, and he is going to make you feel a little better after I got you a little concerned about things. Go ahead. Hopefully, Tim, we'll see.
I will do my best. I will do my best. Thank you, Mark, for the introduction. So at this point of our presentation, I would like to provide a demo of our financial planning tool, which is called My Wealth Hub. And now this program, it allows us to record data on a client's assets, debt, income, and expenses. It also allows us to perform retirement planning and cash flow projections. It also has the ability to show the financial impact on various scenarios. If, say, for instance, a client wants to claim Social Security benefits early or delay it, or if a client wants to retire early. And we have that ability to show those scenarios here through this program. And here what I'm showing is a sample client, Frank and Joanna Miller, both age 50, working, and are looking to retire at age 65. And on this home page, here, this is showing a summary of their overall net worth, their investment assets, how those assets are allocated on the top right chart here, as well as a listing of their accounts. Accounts that either we manage or accounts that are held outside of our management, such as their bank account or a 401k that they may have with their current employer. And one of my favorite features about this program is that it allows clients to establish live links of their outside accounts, which really helps with the financial planning process, especially when it comes to performing retirement plans. The next thing I want to show you here is this report, the balance sheet. So once we've gathered all the client's asset and debt information, that will show up here in the form of a balance sheet. And here we can see a listing of the client's investments, bank accounts, and physical assets here in this asset section on the top. On the bottom, the liabilities are listed out here. This sample client has a mortgage and some credit card debt that they're trying to pay off. The second report here is an asset allocation report. And this report is showing the details of the client's overall portfolio by asset class. And here, if I can point your attention to this top right chart, here we can see that the client here has a diversified investment portfolio ranging from large growth stocks all the way to bonds, with an annual growth rate of 7.9%. And that growth rate is based on 50 years of historical return data for those asset classes. Next report I want to show here is this cash flow report. And as the name implies, we're able to see this client's various cash inflows here on this chart. I'm going to zoom in a little bit so we can all see this a little bit better. Cash inflows as well as expenses, cash outflows. So I'm going to start from left to right, starting with this column where my mouse is kind of hovering over income flows. And this section will show clients' salary, pension, and annuity income, and Social Security benefits that they may receive. To this column over here, plan distributions. This is the column that shows money that a client receives from their IRA required minimum distributions. Total expenses. This is the column showing clients' living expenses, any debt payments that they're making, insurance premiums, and taxes paid. And this last column here, planned savings. This is showing clients' contributions to their employer-sponsored retirement plans, whether it be a 401k or 403b, or any other type of deferred compensation plan that would show up under this column. And that leads us to what I'm about to show you, the bread and butter of this demo. Here, what we call the decision center. This is where we run our retirement and cash flow projections for all of our clients. Now, before we run any projections, we make sure that we've gathered and inputted all the necessary information from the client, such as income from employment, estimated Social Security benefits, pension benefits, as well as living expenses and their debt. We also make certain assumptions when creating these retirement plans, such as assumed retirement age, investment growth rates, and inflation. We can see here this blue bar chart on this page represents this sample client's investable assets netted against their annual living expenses of $140,000. And the time period shown is from today up through the second spouse's death, which is at year 2067. And we can see under this base case scenario, assuming they retire and claim Social Security at age 65, their portfolio assets on average will run out when they turn age 93. And we can see the probability of success by running what is called a Monte Carlo analysis. And this analysis runs through 1,000 trials of a client's plan in order to come up with this probability of success. In the case of the sample clients, the Millers, this projection is showing that they have a 55% probability of success where they'll have at least $1 left upon the second spouse's death. Now, 55% is okay, but it's our job as financial planners to come up and show what other options they have to improve their retirement plan. And the way we do that is by running alternative scenarios. So, for example, how would their plan be impacted if they were to delay Social Security to age 67? Under this scenario, this gray area here represents retirement assets lost when compared to the base case scenario. And as we can see here, delaying Social Security does them more harm than good. And it's actually resulting in their retirement assets being used up by age 90, which is 3 years less than what I had shown in the base case scenario. And here's the reason why. The money that they would have received from Social Security benefits starting at age 65 is now being drawn from other investment accounts. Now, it's a common misconception to believe that it's better to delay Social Security because your benefit amount will increase. But in the case of the Millers, that's not the case. And in reality, it really depends on each client's situation. Now, this next scenario I'm about to show is one that we see many of our clients do when they're about to retire. This scenario shows the sample client, the Millers, selling their primary residence. Let's assume they live in Westfield. They move into their vacation home that they currently own. Let's assume that's North Carolina or Florida. And they reinvest the proceeds from the house sale into their portfolio. And we can see here with the green bar charts here, we can see a significant improvement in their retirement plan, as they've now gained retirement assets that will last well into the second spouse's death when compared to the base case scenario that we first saw. And under this alternative scenario, just running the Monte Carlo analysis, the analysis is showing a 74% probability of success, which is much better than the 55% that we first saw. And so this is the type of work that we do for our clients. We run projections and we run through many scenarios for our clients. Whether they want to see if they can buy a second house, whether they have enough funding to fund their children or grandchildren's college education, they want to gift any of their assets away. Those are just some examples of scenarios that we run for our clients. At this point, that concludes the demo of our retirement planning tool, My Wealth Hub.